Good morning. It's Wednesday, July 16th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So let's take a look at the overnight data and then yesterday's inflation data point that came out. We saw the CPI inflation data come out, and that June's inflation numbers, they provided some insights indicating that the extensive tariffs are contributing to rising prices. So the development reduced the expectations for interest rate cuts by the Federal Reserve. And although overall the inflation figures came in lower than expected, we saw estimates here for less than a 50% chance that the Federal Reserve cuts rates in September. So what did that do? It put some pressure on not only the gold market, it also lifted those Treasury yields, putting pressure on 10-year Treasury notes, boosted the dollar index, and it weighed in on all the foreign currencies. We saw quite a bit of a rotation take place here in a lot of the different markets yesterday. Now, overnight in the UK, we saw traders scale back their expectations that the Bank of England cuts interest rates after their headline inflation for June. Well, that came in hotter than expected. So we saw some volatile price action in the pound, in the euro currency, in the dollar index overnight. Now, you want to remember that when you look at the dollar index and you look and you hear things saying that, hey, the dollar is down 11% year to date. Well, you want to know that the dollar is an inversely weighted basket against other foreign currencies. That weighting takes place where if someone was bearish on the dollar index, but they didn't have exposure, the ability to trade against the dollar, what they could look at is the euro currency, which is a 57.6% inverse weighting. The Japanese yen, 13.6% inverse weighting. The British pound, 11.9%. And finally, the Canadian dollar up 9.1% inverse weighting. So you take the basket of those currencies against the dollar, and it works as this teeter-totter back and forth. So as the index goes up, when the US dollar gains strength, well, that's compared to other foreign currencies. So there's been a lot of repatriation of foreign currencies back to their homeland, and that's boosted those, and they've sold off the dollar in conjunction with that. So you look at US equities, well, stocks, they are edging lower after yesterday's and ahead of today's key events here, which will include PPI, the Fed's Beige Book, and then more big bank earnings. So looking at the S&P 500 overnight, just slightly lower back at 62.80. We talked about this range here, this 62.80 down to 75 on up to 62.90. Well, those are your critical levels of support. And if we continue to hold these levels, you'll see the market run into 6,300 and then finally that resistance point right around 63.30 on up to about 63.37. So looking at the NASDAQ here, it is slipping also after coming into a record close again yesterday, sitting at about 23,000. Low in the overnight session, just slightly lower here, not too much and not too slightly higher here in the overnight session as well. The Russell really got hit because remember, the Russell is one of those interest rate sensitive products, and many of you that have been trading with me have been long Russell exposure and small cap exposure. We trimmed much of that late last week. We also trimmed some of the gold market last week. We also trimmed some of the 10-year Treasury notes that we were holding last week in anticipation of this CPI data coming out. Now we'll start to look at, with that particular data point behind us, we could start to look at adding this exposure back here. Not a recommendation to the public. You'd have to be working with me closely where I would know your particular risk tolerances, objectives, things like that in order to implement some of these different structures here. So looking at the data, we do have 10-year Treasury yields backing off about 1/10 of a basis point, sitting at 447. That 4.5 mark kind of closing in on it, 4.5%. That's going to be also a critical resistance point, and it'll also get the talking heads discussing 10-year Treasury yields as well. Do you want to look at the volatility index? Well, it's slightly higher here, but you're going to have that July contract expire this morning. That's why I'm starting to look at August and September. Not necessarily putting on the volatility index as any kind of means of trying to capitalize on volatility. I just use it as more of a gauge as to what to do in the US equity markets. So as you get volatility coming down, well, what happens? The melt off and the easy path for stocks to continue to move higher and the complacency take hold. You do look at the volatility index though as a possible hedge from time to time on extreme washouts and extreme levels of any kind of complacency. So you do have the dollar index here just slightly lower, and what happens? The gold market gets a little bit of a boost You look at the crude oil market kind of backing off. And if you look at oil, you had that big spike up on the Iran conflict, the big washout when they couldn't shut down the Straits of Hormuz, nor can they really willingly going forward, because they're going to upset their trading partners that are around them. They're going to upset the key region here. And then also it cuts off the money that they make, and what supports their conflict and their different political agendas is that oil market flowing out of it. And that's why you had the big correction. We've got the small bounce up, and now we've got prices working their way a little bit lower. If you do get the chart back, I'll outline the area of interest where we could come into a support level on the oil market. And remember that oil does have some relevance in portfolios against rising inflation, against geopolitical conflicts. So we'll start looking at our minimum positioning sizing in the WTI crude oil market once we get down to key levels of support. We will have earnings coming out from Goldman Sachs, Bank of America, Morgan Stanley, Johnson & Johnson, all before the bell and all before the market opens. We're going to have U.S. Treasury yields. Well, they are hovering around their highest level in a month, and we do have the traders awaiting the PPI data coming out, which could provide some more evidence that there is some rising inflation here, especially with producers who are the front of getting different products here and then selling it out to the consumers. So this is the producer price index. It's an inflation gauge versus the consumer price index, which is what we saw yesterday. So economists, they are predicting that headline PPI prices rose 0.3% in June, and then the core PPI 0.2%. This is an acceleration from the previous month of 0.1%. So we're really going to want to keep an eye on that. We want to keep an eye on 10-year Treasury yields right around that 4.48%. And then you've got the 30-year right around just over 5% here. Now, shifting to Bitcoin, because many of you that are working closely with me have been actively trading in Bitcoin. We're seeing Bitcoin futures up about 2%, Ethereum futures up about 3.25%. Now, it is rebounding after hitting a speed bump yesterday. When that speed bump occurred, we saw that sell-off back down to support. What were many of you doing that are working on my desk closely? Well, you were calling in, you were picking up additional Bitcoins. You were also working some speculative positions for intraday volatility or the next 48 or 72 hours as a swing trade opportunity here. And the reason why we sold off yesterday was we had one key crypto bill. It failed to get the necessary votes yesterday in order to pass. So there's 3 bills that are getting voted on in the crypto. If you trade crypto, you have to know this information here. You've got the Genius Act, which is the regulations and stable coins. You've got the market structure bill. This lays out when crypto is a security or a commodity. And then you also have a bill banning the creation of a central bank digital currency. That's the CRDC. When you see that acronym, central bank digital currency, people don't like that idea whatsoever. So the stable coin section of it, that passed the Senate and can pass the House if it gets the necessary votes this week, and it will be signed into law by President Donald Trump. Now, the market structure bill, that's where things have problems. That's where even myself, I do have a problem with it. And being a trader for the last 25 years and covering things like what we just broke down with the dollar index, with the euro currency, the British pound, things like that, you look at what is Bitcoin? Is it this crypto? Is it a security? Is it a commodity? I could tell you one thing that crypto is not, is it is not a currency. And hear me out for a second on this, because currencies do not move 10, 15, 20% in a day-to-day range. What would happen if all of a sudden your dollar lost 20% in a day? Well, what would happen is that the military would overthrow the government, a coup would happen, and people would be very upset with the government because you can't have that price instability. You can't be taking a wheelbarrow of Bitcoins over to your local grocery store here to buy a loaf of bread. It just doesn't happen. This isn't the Weimar Republic. So that is all my opinion here, and it's just because of the fact that I find it comical that it's considered a cryptocurrency, yet I've never used it really to purchase anything. I don't go to the gas station with a Bitcoin wallet and buy gasoline or any basic materials. So I believe that it's more of this security with commodity features, because commodities do move 10% sometimes in a day. We see things like that in many of the things, like we saw that in natural gas. We'll see that in crude oil. We'll see that in silver move 5%, things like that. So it's more of a commodity per se, rather than anything else, rather than a currency. So that's getting way off topic and a little bit deep. So something else that I've noticed here is that on the silver market, and you look at many of these banks, because a lot of people that trade silver, they'll say that banks are manipulating the prices and blah, blah, blah. Well, Citigroup, they just came out and they expect silver to extend its rally on beyond $40 an ounce here, citing the coming tightening physical supplies and growing investment demand. Now, why would Citigroup have an increase? Why would any of these banks have $40 and $50 price targets if they're manipulating the prices? Are they trying to bait you into the higher prices, sell it back to you, and slam the prices down? I don't know, but that's a whole nother rabbit hole, and we're getting into too many rabbit holes on this particular program. So they're saying that the recent silver price rally here is not just catching up to gold, but it's really a reflection of stronger silver fundamentals, and I really believe in this, and this is where I come in, and I believe in silver as a product because of the fact that the 54% industrial demand, the manufacturing demand, the typical tailwinds that we see once gold tends to peak. What happens going forward here? You look at the financial crisis, you look at COVID. Well, economies, they come out of these small hiccups and these recession talks and things like that, and what happens is the economy propels itself forward. U.S. equities oftentimes bolster to new highs, and it takes some of these industrial metals with it, and that's where silver tends to outperform the gold market historically. Past performance not indicative of future results in the past year, and that's where I think that we could get the $40, $42, $44, $48, $50 silver here coming in the months ahead. So you look at Citigroup and their price forecast. Well, they raised their 3-month price forecast from 38 to 40. That kind of corresponds with what we're thinking here. And then you go to 6 to 12 months out, they're thinking about $43. So we could see some blow off tops and some exposures like that where we do get that kind of movement higher. You go into the gold market. Well, there's a bit of a change here where that particular bank here does believe that gold prices are going to come down to about the 3,000 level. I've seen many other banks out there come out with 3150 and things like that. And it's really the rotation that takes place. Goldman Sachs is one of the most optimistic ones out there with $3,700 price target by year end and 4,000 by mid 2026. So we'll see who is right and who is wrong on this particular things. Otherwise, ETFs, they added a little bit of gold here yesterday. They took off quite a bit of silver. Another 4.2 million ounces here of silver was sold out. So you get the gold silver ratio at 87 to 1. Now looking at some outside markets here, one of the markets that I'm going to monitor here today, well, two of them, for instance. One, natural gas prices swinging and moving higher. You do have a tropical storm here that should cut across the state of Florida, could impact some of those rigs and things like that just off the Texas coast, and natural gas production could be shut down, oil production, things like that. So I think natural gas prices, this is where we're seeing some volatility. Plus, it's quite hot with heat index down here at 116. I can't even go outside. Secondly, a market that I'm looking at here, which could have posted a long-term low here, is the sugar market, which has a bull flag. You get the chart back. I'll throw that up on there. And we may have seen a long-term low in place. So you get the bullish supply demand. You get consumption from the USDA. Well, that increased from 2024-2025 crop on up into the 2025-2026 expectations. You also got global ending stocks here falling to the second lowest level in 14 years. You got India. They are boosting their production, but they're concerned about inflation. So what do? They curb their exports here. And we're also seeing Thailand do that as well. And you're seeing overall global production here a bit lower. So if you don't have a notebook, you should always have a notebook where you keep notes on what you're looking at here and your observations in the trading market. So you guys got any questions? That was a lot to unfold here. Don't mean to get down to any rabbit holes. I don't want to trigger people when it comes to manipulation or this or price objectives and such and things. I'm just trying to report some of the observations that I see, and I really do this video for myself, for my coworkers and things like that, so they know what I'm also doing at, because I am away from the desk here and I'm not in the Chicago office. So I like to keep everyone posted as the observations that I see. So remember, futures option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.